IVM.
On this episode of Paisa Vaisa, I speak with Gaurav Rastogi, CEO and founder at Kuvera. We are going to talk about the behavior edge for investors, stuff that you can do to give you a better than average performance on your portfolio. So stay tuned for that.
Welcome to Peak Planet, a new podcast where we delve into the fallouts of the growth path that we and indeed much of the world has chosen. Sustainable growth is the buzzword. Until we nail that down, we need to ensure that we keep our population healthy and also have the resources for our increasingly urban lifestyles. I'm Karthik Ganesan, a researcher at the Council on Energy, Environment and Water, a Delhi-based policy research institute where for almost a decade we've been trying to explain and change the use, reuse and misuse of our resources. In the first season of Peak Planet, we take up air pollution, public enemy number one and an invisible one at that. Increasingly, the most important risk factor for adverse health outcomes, air pollution has become the most unwanted byproduct for an aggressively growing economy. Over 4 episodes, we find out how prepared our systems are to deal with this crisis. You can catch the entire first season of Peak Planet out now on the IVM Podcasts app or website, or wherever you get your podcast from.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and we love returning guests. And today's show is kind of a continuation on where we left with this guest. That's Gaurav Rastogi, CEO and founder at Kuvera. Just a few months ago, we were talking about investor behavior. This episode is going to be about investors' edge. How do you approach your investments? What are the ways that you want to make that extra money? Whether it's beating the index or getting probably some kind of an extra return over the indices or beating them and outperforming. We're going to analyze what are the sources of that, how it comes, how it doesn't come, where we go right, where we go wrong. And without further ado, I welcome our guest for this episode. Gaurav, welcome back to Paisa Vaisa. It's so good to have you out here. Thank you for taking the time out for us. I believe you're already gone this weekend back to Singapore.
Thanks, Anupam, for having me here. You're right. Yeah, I'm flying back tonight, actually.
Okay, so let's just take off from where we had left in the previous, when you were here in the studio and we were talking about how investors behave, because a lot of our investments, when we buy, when we sell, the financial plans that we make and the financial plans that we probably interrupt. This recording is happening somewhere in August and the markets aren't doing particularly well, and that itself triggers a certain emotion in us. So you've got a nice structure to this. You've analyzed how we as investors try to get the edge. That's what the episode is titled, Investors' Edge. And you've got sources of these. Okay, so let's just jump right in. Okay, what are these sources of this investors' edge that we have?
Sure, right. So, at a very high level, there are 3 different buckets you can think of on how you can get better returns than an average investor, right? So we are all assuming that every other investor is also trying to do the same. So the conflict here is not that, you're the only one who wants to get higher returns. Everyone wants higher returns, right? Like you tell someone you'll get 2% extra, their eyes light up. It's the whole greed thing that kind of drives you to start investing in the first place. So if you think about it, there are 3 different things that we think of, right? The first one is, do you have an informational advantage, which basically means you get information before anyone else gets it, right? So there's a very famous example, pretty much everyone knows of it. This goes back to the Battle of Waterloo, the famed, the Rothschilds, right? So the Rothschilds got the information that Napoleon had lost the Battle of Waterloo about 2 days before the government of Britain got the information. That's how good their informational advantage was. So they had a 2-day advantage. No one else knew this. So what the Rothschild did, that instead of buying securities, he started selling bank paper and created the rumor that England has lost. So what this created was panic, because everyone knew that, okay, this guy knows something that no one else does. If he's selling, we should also sell. Everyone started selling. There was widespread panic for 2 days. And then he comes in right before the government gets the information that actually Napoleon had lost and Britain had won. He just buys back all of that paper for pennies on the dollar, right? So that's a very simple example of having an informational advantage where you know something that no one else knows, and that advantage allows you to take a decision that other people can't, just because they don't have that information with them, right? So,
and just for background, the Rothschild at that point of time was this hugely wealthy, hugely influential, hugely powerful
banking family. Yeah. They still are. It's one of the few family banks that have survived generations and actually, built a very big industry out of it. So the point also is that this informational advantage has now almost gone away. Right? Even in India, you would hear this story a lot that there was this insider information. People would know before anyone else did. There were some doyens on Dalal Street who would find out before the rest of the market. So you could kind of, what they call it in the parlance is, you could front run and make money before other investors came in.
One of the examples that comes to my mind, and this is quite well known, is on the first of every month. And today happens to be the first. You have sales numbers coming out from cement companies, from auto companies. So one way of playing the market used to be that maybe 2-3 days before the first, you would call up dealers, or if you knew a few dealers, influential dealers, big dealers in big cities,
or might I say people in the company itself.
Oh yeah, people in the company itself. Right. And get an idea that okay, this month sales have been up or down, and then you have a general pulse that okay, the market is expecting 10% growth, and that it's going to come as a much better number. That information that you have from your contacts, from whatever you've done, is what you're referring to as the information edge.
Exactly.
And just to be clear, there's a bit of grey area here today in this era. Where,
it's not just, it's illegal now. So SEBI has very strict rules. All material public information has to be disclosed at the same time, right? So it's kind of made it very difficult for people to participate in this, right? Plus, to do this, you have to create an infrastructure to get that information, right? And, I mean, it's not easy to collect information. So that's one source. That's one big source. It's definitely an advantage if you can create it. But it's very, very hard to create. So that should be the takeaway.
And stay within the legal confines.
Stay, of course, always stay within the legal confines. To repeat, that's a very valid point. Stay within the legal confines, right? The second way that you can make more money is by saying that I can analyze whatever material public information that has been released. I can analyze it better than everyone else.
This is an important one.
This is an important one. This is basically saying I'm a better analyst than the average analyst in the market. Now, there are two things that happen here. One is that if you look at India, right, if you look at Dalal Street, if you look at the number of portfolio managers whose job is to identify these companies, you look at portfolio management services whose job is to identify these companies, you're competing with some very learned, very motivated people. And you want to outperform them, right? Because they are getting paid a lot to do this. I mean, people want to become portfolio managers. It's a job people want because it pays very highly. And so your claim is that, no, I can analyze a lot of this information better by looking at this data, which everyone has now. So there's no informational advantage now. Everyone has the same material public information. So the context that comes to mind is what we call the overconfidence bias. Again, it's a very well-known bias, and it's probably... It's important for us to have this bias. It allows us to take certain risks, to believe in ourselves, to do better in life than we would have otherwise done. But it also creates this perception that, I can beat the average, right? So a famous example is from the 1980s in the US, where they did a study. They found that 93% of the drivers think they are better than average. Now, statistically, this can't be true.
Yeah, I mean...
But this is the overconfidence. Everyone thinks that they are better than average is thought to be as a very low bar.
So if you have the bell curve, people think that they're actually in the right-hand side, whereas the average is right in the middle.
Always. I mean, there is... this is just driving, right? So I think there was the professors at Duke University, right? They ran this experiment where they would go to the CFOs of the largest companies in the US and ask them to predict what S&P would do 1 year out. Not long-term performance, just 1 year out, right? And these are CFOs of the large companies, so they have very good information about how their businesses are doing. And CFOs are usually friendly with other CFOs.
So you have an idea what competition is.
Exactly. And you know what the consumption looks like, what the financing looks like. So you have a lot of real data. And they collected some 11,600 such data points. What they found was that there is no correlation between what the CFOs think the market will do in the next year and what the market actually did.
Wow.
So the point I'm trying to make is that do read about overconfidence bias. Do read about this because we are hardwired like that. We were hardwired like that, and it had a lot of evolutionary advantages for us. But in investing, it can actually become like a thorn because you will think, oh, I can beat all of these people. But, you might have gone to the best colleges. You might think that you have the right analytical tools, or you can write the right code to analyze tons and tons of data. People you're competing with have very similar skill sets. I mean, everyone I talk to in the industry, right, a portfolio manager or a portfolio management services, they're impressive people with good pedigree, with good understanding and knowledge. I would think twice, thrice, 10 times before saying, you know what, somehow me sitting in a room or, like doing a day job and also investing can somehow beat people whose day job is to do this.
I want to just go into that before
Sure.
we go to the third point, a little
Sure.
bit in depth, right? Because I want to just give our listeners an idea of what their day job is like. Okay, now let's say that I am a complete outsider.
Right.
My day job might be I have a maybe I'm working in the mall, or I'm working in a company and I have my own money to handle. Maybe it's a small amount, but one fine day I wake up and say I'm going to handle my own investments and I'm going to beat every fund manager out there. Okay, I want you to tell us, what does an average fund manager, okay, maybe an analyst on the buy side as we know it,
Right.
what does his job look like? When he wakes up, comes to office, or looking at it in another way, what all does he analyze? Okay, so that I know what I'm up against and what I have to do.
Sure. So one thing is that their entire job is around markets, right? Their friends are analysts, they're friends with portfolio managers, they're friends with all the senior management of the companies. They will attend every single corporate event. So the numbers are being released, sales figures. So think of it like this. They will analyze all the data that a company has released, which is their sales numbers, their revenues, their sources of sales, their sources of competitive advantages. Then a good analyst, right? And there are quite a few good analysts, will then go and talk to their suppliers. Do these numbers add up? They will go and talk to their customers. Do you actually like this product, or are a lot of these sales figures inflated, right? So there is this person who's obsessed with this company, right? An analyst will probably have a sector that they are covering or a bunch of companies they're covering. And
just to put it in perspective, if you're covering the banking sector, you've got 30 stocks at least.
Yep.
Yeah.
Yep.
Okay.
But they're all very similar.
Yeah.
But you are talking to these people. You're talking to the banking in the day in and day out, right?
Yeah.
Anything that's happening, what's happening on the regulation front, they'll know it.
The RBI is going to cut rates. The RBI is going to have a policy. You have to know what's happening out there.
Exactly.
Yeah.
That's their job. Their job is to know everything inside out about the banking industry, create a macro picture on how that compares to where the economy is and what that means for their industry in the near future, right? So it's like it's like saying that and investing is special also, and I'll tell you why. You go out and you talk to an individual who works, say, at a company, and you say, if you play 2 hours every day, do you think you'll become as good as Roger Federer? Or even as good as the 200th rank male tennis player?
Yeah.
Of course, everyone will say, no way. But in investing, somehow people believe
that they can.
That by watching some financial news, by reading some financial papers, by doing a little bit of math in Excel, they can actually compete and beat a lot of the professionals whose entire job is to do this, right? And in a large sample of people, if 1 million people believe that they can beat the professionals, by just chance, by just luck, 20 people will. But is that sustainable? Can you do it year in and year out? Because the other thing about investing is 1 year returns don't matter. What matters is, your investment time horizon is 20 years, 25 years. What matters is how much can you build in 20. So now, do you believe that you can do that for 25 consecutive years? So again, the point I'm trying to make is it's a hard thing to do.
Not entirely impossible. If someone has
Of
the
course.
effort, please, they can go ahead and try it for that matter. But you just need to align your expectations.
You have to align your expectations, and you should not just have this overconfidence that it's an easy thing to do. Just it's like what you say, right? Like, know your competition, and treat them with respect.
Yeah.
Right? I mean, they are equally motivated. They are equally smart people. So that's the part about the second one, right?
Sure.
So if you think about these two, then we say that okay, it's very hard to get an informational advantage. It's very hard to consistently analyze better than the average investing public. What we are left with, the third, which is what we call the behavioral advantage. And this, we believe, is a real advantage.
Where you're behaving smarter than the others.
Where you have better self-control. You understand the different biases, and you have a active methodology to not fall for some of them. Simple examples: you don't overtrade. Right. Last time we spoke about the behavior gap, which is when a lot of people will start SIPs when Nifty is at 12,000, but they will stop it as soon as Nifty gets to 10,000. Effectively saying that at 12,000, I was a happy buyer, but at 10,000, suddenly I'm scared.
Are you in fact seeing that? Because we've had the Nifty correct.
So, I mean, in small cap, mid cap a little bit, most of our investor base has, I mean, so we do also publish a lot of this commentary in blogs and in articles to our investor base, trying to tell them that, be wary of this behavior gap, don't fall for it. We are seeing flat, so it's not growing anymore. So I think till about 2 months ago, it was growing perfectly well. I think June and July, it stayed flat, which is a pretty good thing given what the market's been doing. But I think what's also is true, and the true test will happen when the large cap falls 20-25%.
Which we haven't seen as yet. Yeah.
Nifty is down from 11,900 to 11,000. Again, we are in August right now, so early August. So it's a 9-10%, right? 9-10% people are like, I'm in for the long run.
We can take this.
20-25%. I think I'm in the long run, but I'm not really sure. 30-40%, forget long run. Right, so we have to get there to see if the behavior has actually changed. But so far, the signs are very promising, and we say that in our communication to our investors that the signs we are seeing are very promising. People are not panicking; they're continuing their SIPs. They're actually increasing their SIPs. Our SIPs per investor is up like 9% year to date. So signs are promising. The stress level is not where we think the actual test will come. So we'll see that. But this behavioral advantage is a real advantage. And it is something that anyone can practice. All it needs is a more patient approach to investing, a truly long-term approach to investing.
And on that note, folks, we are going to take a small break. On the other side, we are going to go deeper into the third point that Gaurav just said, which is the behavioral edge. He spoke about how to manage your expectations and how to behave properly, so to say, when the markets are going up and the markets are going down, because while you might not have an information edge or be as good as professionals on analyzing certain companies, the third part is what we're going to delve into more on the other side of this break on this episode of Paisa Vaisa. My guest, Gaurav Rastogi, CEO and founder at Kuvera. Don't go anywhere. We'll be right back.
Hey everybody, welcome to another awesome week on the IVM Podcast Network. If you are not following us on social media, please do. We're IVM Podcast on Twitter, Facebook, and Instagram. I'd like to thank our sponsors for the week, Storytel and Intel. Sponsors make this stuff possible. Please shout out to them. Let them know that you appreciate them paying us money. Also wanted to remind you all that we have an audience survey going. The audience survey is only going to be up for another couple of weeks. And I'm frankly disappointed. Even though 3 times the number of you people are listening to us as the last audio survey, only half of you have filled it out. So yeah, come on, please get to it. ivmpodcast.com/survey. We want your opinion to matter when we decide what we're going to do in the future. And I'm sure you want yours to matter too. So please do fill out the survey. A quick note, one of our favorite shows, States of Anarchy, hosted by the awesome Hamsini Hariran. This show is going to move to a fortnightly schedule starting 21st January 2020. Keep listening to it. It's a great show on global affairs, foreign policy, and more. On Cyrus Says this week, Cyrus talks to YouTuber, actor, and comedian Sahil Kattar. Sahil talks about the discoverability of artists through YouTube, playing Syed Kirmani in the upcoming film 83, and watching Cyrus on TV while growing up. On Golgappa, host Tripti is joined by Girija Godbole. She speaks about how acting and theatre shaped her as a person. On Storytellers and Storytellers, Vineet is joined by Chitra Subramaniam from Cross Films and by Rahul Sarangi from TVF to talk about the export quality of entertainment. On the Empowering series, Zarina is in conversation with the host of Top Retail's Madhuri Advani. They talk about storytelling and ongoing issues in our country from CAA, NRC, and protests. On Agla Station Adulthood, Ayushi and Ritasha are joined by Andre Borges, a content creator, to unpack NRC, CAA, and how it's going to affect our country. On the Geek Fruit podcast, Tejas, Dinkar, and Jishnu talk about the best things according to them in pop culture from the 2010s. On the Habit Coach, Ashton talks about the fear of failure and how it's fine to fail. On Tapri Tales, Madhuri talks about the characters and gullies in her hometown Baroda in Gujarat as she tells us a story about his past and his present. On Ganatantra, hosts Saryu and Alok speak to Jean Thomas Martelli, who is writing a book on the Jawaharlal Nehru University and how a university becomes a hub of political activity. On Football Shitball, hosts Gaurav, Karthik, and Sivran celebrate the New Year episode and talk about the last week in football. And with that, let's get you back to your show.
And we are back. This is the Investors Edge special with Gaurav Rastogi, CEO and founder at Kuvera. In the first part of this episode, we were talking about how you have an informational edge, which actually has become very tight these days. It's very difficult to get when you want to do better than the average. The second thing we spoke about is how you might have some overconfidence bias, where you think that you can analyze a company or a sector better than professionals, and you think you can actually beat those professionals. Yeah, it's possible, but it's difficult, really difficult. And then Gaurav told us about the third part, which actually is the most practical, most useful, and probably, who knows, even the best way for you to actually beat the average, which is the behavioral edge. Okay, Gaurav, tell us more about this behavioral edge. Okay, because as we were just talking when we had gone on a break, there's stuff that I can do as an investor. If I have an SIP, or if I actually have, I don't know, maybe I'm holding a portfolio of 10 stocks, 15 stocks. I actually have an advantage, you said, as compared to professional fund manager. Let's delve into that.
Sure, right. So see, what happens is, as a professional portfolio manager, you have to show those returns year after year. You are being judged on an annual performance or a 3-year track record or something like that, right? So you have this immense pressure to try and outperform on an annual basis, right? So some of your decisions can then be a little bit more short-sighted, or might be driven by factors which are not necessarily best for the long-term portfolio. A lot of portfolio managers do understand it, and they might want to kind of correct for it, but then you're working for larger organizations. That organization might want you to take certain actions so that the returns look better, or they think will make the returns look better. No one actually has a magic formula for that, unfortunately. Yeah. So as an individual investor, if I am 30 years old and I know I'm going to retire at 60, and if I can have this frame of mind where that annual return doesn't matter to me, all that matters to me is that directionally in 30 years, I'll have this retirement corpus, which is big and which is going to take care of all my retirement needs, then I immediately have this durational advantage, because I'm not looking at 1-year returns, 3-year returns, 5-year returns. I'm kind of like sitting tight, enjoying my life, doing really good at what my day job is. Right? Like, sometimes someone will ask us, what's the best way to make money? Be really good at your day job. Get a promotion year after year, right? Simple stuff. So, that edge is actually very real, and you read these stories where people will say, my dad bought some shares of Wipro in 1982, left the share certificate in the Almirah, and now 30 years later we have found it and it's worth like some
mad amount, because
right?
Bonus, because split, and because the stock price went up, and dividends and all that. You add all of that,
and it's Wipro, right? And it's done phenomenally well.
Yeah.
So but the key part of this story is, people left it and forgot it. They never knew it existed, so they couldn't take any action on it.
And that's actually a behavior.
It's actually a behavior.
Yeah.
It's a behavior in the sense that sometimes not exposing yourself to certain kinds of stimulus is a good thing, right? Like, for example, don't follow daily financial news. Don't follow what the market is doing every day, right? Like, if you have your plan in place, if you have your SIPs in place, and if you kind of know what your asset allocation is and it is in line with what it should be for your age, then just check the markets every 6 months and make small adjustments to your asset allocation. Your plan is in place, you have a long-term horizon. Checking the market day in, day out, and oh, I should buy this, oh, I should sell this. It's not going to, on margin, create any value. And what we have seen when we spoke about the behavior gap, it actually creates a 1.5% lag.
I was just going to ask you that. Is there any data that actually, shows that what is the impact of this,
Yeah. There have been, so we know of at least 2 studies that we have also written about this. One is US mutual fund investors, I believe 1999 to 2007, where they find that the mutual fund investors, they achieved 1.5% lower returns per annum than the mutual fund return itself, because they were buying after good years and selling after bad years. There's a similar study from Norway, and that shows a 1.4% per year lag. So just by trying to be more proactive, right? You think you're being more proactive. You think that will make you better. it actually doesn't. And there's another example. So I think Intel did a study where you check emails, a regular employee will check emails 50 times a day because they think if I'm checking emails, I'll be always on top of stuff and that'll make me more productive. It does not.
Okay.
Right? So sometimes it might be obvious to think that, okay, I'll take this action and it's going to be good for me. But it's not necessarily true. So avoiding stimuli is not a bad thing.
Okay. At Kuvera, how do you guys communicate this? Okay, because I'm sure that maybe you get, I don't know, phone calls or emails or people on Twitter or social media keep on asking you, what do I do? What do I do? What do I do? Because if I'm not mistaken, Kuvera actually helps you to sort your goals, plan for them and achieve them over a long period of time.
Yeah.
So this last question that I have is, one obviously is how do you guys handle this on a day-to-day basis, especially in times like these? Okay, I don't know, hopefully by the time listeners listen to this, maybe the markets have settled down, maybe that's the case. One is that, and I want to end the episode, okay, with some practical tips on behavior. How do you sort your stuff out? So first, how do you guys handle your investor base?
Yeah. So see, for a company like ours, right, we're a direct plan platform and we're free. Handling it on an individual basis is harder, but what we do is we write a lot of content around it. We write a lot of content around recent events in the market and how to interpret them, right? For example, infrastructure funds are up X% in the last 1 year. But have you looked at the 10-year performance? 10-year performance could be absolutely atrocious, right? So that will give you some sense on, okay, this could just be a blip in the radar. Why are you chasing it, right? So a lot of what we find is giving people relevant data, giving people the right kind of models to think at the right time creates this impact. And for us, the easiest way to do it is through content. Very honestly, right? I mean, we blog about it, we write email newsletters,
sure.
And that's how we handle it. For us, it's very hard to do it on a phone call or an individual basis, right? So we also think of nudges right at the time when someone is trying to take an action, right? So when the markets get volatile, and if you're on Kuvera and you're trying to sell, you will see a message. It'll be a very subtle message, not something blinking and all. It'll be a message that will say that if the only reason you're selling is because the markets has been volatile, then read this.
Okay.
And it takes them to a blog where we talk about this some of the same concepts.
Sure.
Idea being that a lot of these decisions to buy and sell are very instinctive. Okay. Right? So if you can even delay that decision-making process by 15 minutes, right? It's like the heat of anger. You just have to kind of push it out a little bit to see if that will actually change and saner minds will prevail. And we see a lot of that happen. People will come to that page, but instead of clicking sell, they'll click that link and then they will not sell. Okay. Some people will, of course, continue to sell. It's not always that, people are wrong. You might need cash or something,
sure. Yeah.
Right?
It's legitimate demand. Yeah.
Exactly. Yeah. And there is a lot of it, right? I mean, you're investing for a purpose, right? Yeah. It's not like you're investing just for the fun of it, right? You want to buy things, you want to do things with that money. So you're investing. So people might need the money. So we try and use these two kind of like, at the point of action, can we kind of give certain context to what are good behaviors and bad behaviors, and writing content around how to kind of, think about some of these concepts, at least for an investor to be aware that this literature exists, that these concepts are out there, and what they are feeling, what they are going through is not unnatural. Everyone gets scared when the markets are down. It's a very natural thing. You're losing money, hard-earned money.
Yeah.
So how do we kind of, overcome some of that? So yeah, that's our endeavor.
So, just the last question. Anybody who's investing in the equity markets, okay, sees these ups and downs. 2017 was a fantastic year for small and mid caps. Last 2 years have been horrible. Yep. Okay, so anyone who has an SIP for the last, 5 years maybe, or maybe even 3 years, they would. So a 5-year guy might at best see, maybe a plus 10% return.
Lower than that.
Okay, and most of it is because of 1 year. Okay,
yep, exactly.
So I'm someone who's invested for 10 years. 5 साल हो गए sir, आपने तो कुछ बोला था कुछ हो रहा है.
Right.
Okay,
right.
One is that.
Yep.
Second is, let's say someone who's actually invested in debt mutual funds. Okay, I don't know, maybe he was sold a credit risk fund for some reason and then things haven't gone as per plan. So I want you to just wrap up this episode with some practical behavioral tips that would help our listeners at such juncture, at very sensitive junctures where you're about to take that decision that might actually harm you in the long term. Okay, so how should they think this through?
Fair enough, right? So, couple of things come to mind. One that we talked about, which is try and avoid stimuli, right? So, which is basically saying don't check your portfolio on a daily basis. Don't even check it on a monthly basis. If you think you have the right asset allocation, if you think you have the right SIPs, just let them run. You de-risk as you come closer to a goal, but otherwise don't mess around with it. It is what it is. It's going to go up. It's going to go down. No one knows when, by the way. Right? No one knows when it's going to go up and no one knows when it's going to go down, right? Yeah. So predicting the market is not what you should be thinking of. So that's one. Second is one very practical tip is that have at least 2 or 3 people that you speak to before you do any transaction. So you have this burning desire and, you're reading all this news, gloom and doom, things are going to go bad. Everything is, going to turn to ashes. So I'm going to bail out. Before you do that, talk to 2-3 people, right? At least kind of give yourself that one day of time where you can, maybe some rationality can prevail. Maybe a different thought process can take root in your brain rather than just clicking the trigger, right? Pulling the trigger. Probably. Get perspective, right? Yeah. That's one. Third one, what I personally like and I've also followed is when market gets to a certain level or when markets are going up, everyone will tell you, if it was down 20%, I would have invested a lot. Now that is down 20%, how many of you are investing? Yeah. So a good thing is to actually write these down and put them in your calendar. Okay. If the market falls to 10,000, I'm going to invest 1 lakh. Have this and make it like on the first of every month, there is a reminder that pops up that literally says, on this date, I promise myself, if the market goes to 10,000, I'm going to buy 1 lakh of equity.
Whatever the number is. We don't get to specific. It could be 8,000, 12,000, 14,000. Just have some, some basis for a certain target.
Right. And this reminder is coming every month, regardless whether the market is going up or going down. So when the market is going down, you're like, yo, dude, I really promised myself I'm going to do this. I should actually do this. So there are ways to try and reinforce some of this good behavior. And actually, these are the 2 and 3 things that do matter. It's not very, we don't also want to make it like a rocket science. You have like a 10-step program because no one follows the 10-step program. Sure. I won't either, right? So it's the simple things. It's the simple behavioral stuff that actually works. All you want to ensure is that you're not transacting more than what is required, and you are not paying the behavioral gap, but you are actually earning the behavioral gap.
Sure.
And that's your edge.
Yeah, great. Folks, that is a wrap on this episode, The Investor's Edge with Gaurav Rastogi, CEO and founder at Kuvera. Just some notes for you guys, what we spoke about. Okay, number 1, 3 sources of investors, Investor's Edge. First is the information edge. Okay, you might, that edge is a little bit difficult. You get information ahead of the market and you trade on that. Is slightly gray area. You want to take care about that. Not really possible these days. Number 2, the Analysts Edge, you can call it so, and you can call it the Analysts Edge. Maybe that you think that you can analyze a company or a sector much better than professionals who do this for a living. Who knows? Maybe you can, but it requires tremendous efforts, and you're not sure whether the results actually might be worth it. And third, the one on which we spoke a lot about is the behavioral edge, stuff that you can do mentally, behaviors, okay, good habits that can actually get you better than average returns over the long term. Remember that over the long term, the chances of that the markets actually increase the chances of them delivering a positive return. For example, if you have a 10-20 year plan, don't try and mess with it every time the market goes up and down by 5-10%. And stick to your goals and don't force yourself to take any such rash decisions. Gaurav, have I wrapped that up properly?
Perfect.
Fantastic. The website is kuvera.in, Kuvera.in. It's got a lot of resources, a lot of blog posts, a lot of stuff that you can read. My guest, Gaurav Rastogi, CEO and founder at Kuvera. And that is a wrap on this episode of Paisa Vaisa. Folks, if you like podcast, leave us a rating, leave us some feedback. I'm B50 on Twitter. The IVM website also has a dedicated feedback section. You could check out the website and leave us a mail out there to tell us if this worked for you. If you have any ideas, do let us know. Feedback is seriously important. That's a wrap on this episode. Thank you for listening.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
What do we have to do?
Welcome to What a Play, you guys. This is the favorite sports podcast of several sports persons such as myself, Dudeja and Mikhail, who also happen to be the hosts.
Yes, you should definitely listen to our podcast for our take and quite a uninformed but hilarious take on sports every week. We give out awards, we discuss what happened in the world of sports, and
we take breaks as well.
We come up with jingles and sound effects on the go. So you should definitely give us an example of a sound effect, Dudeja.
Bolo Matthew Vade.
Yeah, tune in for some of that, bro. You can catch us on the IVM network every Wednesday on the go. On the Wednesday, in the Wednesday. Yeah, Wednesday, What a Player. What a Player W, Wednesday W. Wow.
Oh, Wednesday.
Wednesday to Wednesday, What a Player, Matthew Vade.
Hello everyone, welcome to Tech Careers in the New podcast series presented by Accenture, and I'm your host Shiladitya Mukhopadhyay. In this podcast series, we'll get you the latest and greatest in the world of technology that's shaping the future of business as we know it. We're talking intelligent platforms, cloud, AI, blockchain, extended reality, and a whole lot more. Every fortnight on Wednesdays, we'll have for you a hot topic with expert speakers from Accenture talking about top trends in the space, how these are changing the world and creating growth across industries. And more importantly, we'll tell you how you can learn more, build your skills and expertise to grow and stay relevant in your career. Episodes out on the IVM Podcast app or wherever you get your podcast from.